Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
It is now day two of the market kind of digesting what has happened over the weekend with the raid in Caracas and the capture of Nicolas Maduro. And of course, we've seen energy companies move up and down. Today, they are down. They're the worst performers in the S&P 500 if you look at 11 groups. And I'm just looking at some of the worst performers. They include Halliburton. They include Marathon Petroleum. But it's the oil services company that I want to really dig into here because many people say that they will be beneficiaries of the rebuilding of Venezuela's oil industry. Let's bring in Scott Levine. He's our senior energy services analyst here at Bloomberg Intelligence. Scott, make the case for why Halliburton, Schlumberger, and Baker Hughes are well positioned.
So in order to have, oil producers like Chevron, Exxon, and Shell, participate in the turnaround of the Venezuelan oil industry, we need to get the machinery going, basically, and the machinery is in very poor shape after decades of poor governance and management and a lack of investment. Really, since the Chavez administration expropriated assets. And so, who are the experts in doing so and getting that machinery going again? It's the oil field service companies and energy infrastructure companies that need to make investments. They're the ones that own the drill rigs. They're the ones that are experts in fracking. They're also experts in developing pipelines and storage capacity and doing all the things that are necessary in order to make the oil and gas engine hum, so to speak.
I do watch Landman, so I consider myself an expert on all this stuff now.
Okay.
Before this weekend, what did those big oil field services companies, how did they view Venezuela? Kind of like a no-go zone kind of thing?
Yeah, pretty much. They weren't owed billions of dollars. They didn't have assets expropriated the same way that companies like Chevron and Exxon that own reserves do. However, they're owed hundreds of millions of dollars for work that they've already done. And really, once the Obama administration started putting sanctions on Venezuela, they started, pulling out of the country, and that only intensified in the Trump administration when they started sanctioning the energy industry directly, and they haven't been back since. Some of them are carrying receivables on the books still and reserves for losses and what have you, but they've been out of the country really since then and are waiting for a more hospitable environment to get back in the game there.
I mentioned the share prices earlier about how energy stocks are the worst performers today. Of course, yesterday they were soaring. Halliburton up 7.8%. Today, off by 3.5%. Schlumberger gained almost 9% yesterday, giving some of that back. And Baker Hughes rallied 4%. It's going to take a while for all of this to play out, of course. What kind of timeline are we thinking about here? And what are the other business prospects for the Baker Hughes, the Schlumbergers, and the Halliburton as we wait for Venezuela to stabilize?
Yeah. So, this has really been a tough group over the last several years in general, and a lot of it has to do with the oversupplied oil market. I would view the majors that you mentioned as early to middle inning beneficiaries of this cycle. And the reason I say that is because the machinery needs to be fixed before anything can really happen, right? So the first thing that needs to happen really is we need confidence that access won't be expropriated, that the U.S. is in there and is going to oversee this transition, or at least have a heavy hand in it. And these companies will actually get paid for their efforts, and that they can have confidence in that against the backdrop which we just went through, right? And so, we'll get more visibility on the specifics, and maybe we'll get some commitments from some of the major oil and gas producers and visibility regarding the government maybe backstopping some of these payments. confidence that this is going to be an environment where these companies can invest for the long haul and participate for the long haul. They're not going to have to spend as much as the Exxons and the Chevrons of the world. They're more beneficiaries from a business perspective, but they have been burned, obviously, in the past, and they're going to want to be pretty confident that won't be the case here again.
Do you think the industry can get, quote unquote, confident by, I don't know, a guarantee from President Trump?
I do. And I think that's what you saw. I think you saw confidence in that yesterday in the gut response of these stocks. And I think, frankly, they outperformed most of the super majors for that reason. I think there is confidence here, given what we've seen. We don't have a lot of the details yet. Right. But we don't, the market doesn't generally need those details in order to draw a conclusion one way or another. We'll get a sense this upcoming earnings season, which starts in a couple of weeks, what these companies make of this whole situation. But a good analogy might be Mexico. Mexico, not to get off the topic, has also, as these companies have hundreds of millions of unpaid bills or late paid bills from Mexico. Mexico is not Venezuela, so to speak, but you also have Pemex, which is like PDVSA, a very financially challenged, operationally challenged, quasi-governmental entity, and these companies are still doing business there. So it might be good to use that maybe as a little bit of an indicator of what to expect in Venezuela.
Just very quickly, you mentioned that we might get some more insight during earnings season when the executives are talking to investors. Who among these companies is most likely to be a voice that you'd be listening to that might say something helpful or useful?
Yeah. I mean, I think Halliburton really is kind of the one that is most levered to North America. They and Schlumberger really are the two biggest players from a services perspective. I think Halliburton's loss reserves are a little bit higher than Schlumberger's, or SLB's as they call themselves now. But those would probably be the two that I'd keep the closest eye on in terms of their involvement. They have been the biggest players there historically.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's take a look at Nike here. The ticker's NKE, trailing 12-month basis, down about 12%. It's got a $94 billion market cap. Definitely got some inventory issues like a lot of retailers had coming out of the pandemic, and some issues with China as well. A lot of retailers are dealing with that in the athleisure space. But let's go to the expert here, Poonam Goyal, Senior U.S. E-commerce and Retail Analyst. Poonam, I know Nike's a name that you've been highlighting for clients. Give us a little update here. What's going on with Nike?
Yeah, so we think the Nike turnaround is possible. We see finally some light at the end of the tunnel. Their North America business has improved and is going to improve as they rationalize inventories. The issue still is China, and the struggle in China, we don't think will end anytime soon. In my mind, it's a 1 to 2 year turnaround. But that said, if they can get everything else right, which I think they are doing and will get to, I do think that Nike's turnaround is well underway and investors will begin to appreciate it.
So let's dig into the struggles in China. I mean, you're talking about a long time frame here for things to turn around. Is it just that Nike has lost its appeal to the Chinese consumer? Is it competition that's really stepped up in the last couple of years?
So it's a few things. Number one, Nike in the US and other parts of the world is perceived as a more affluent athleisure brand. In China, it is not. What's been happening in China is that Nike has been selling at a discount to clear inventory as the vicious cycle of weaker sales has led to more discounting. So it's more seen as an off-price brand. That needs to change. They know that needs to change. I think that's the first step in solving the problem. And I think what they will do now and what they've said that they do, and I do believe they will because they did it in the US, is they will clean out that aged inventory. But as we know, that will take time. In the US alone, in the last year, we've seen that it takes anywhere from 12 to 18 months. The US is finally in a place where in the next 3 to 6 months, they should be clean. So, which is why we think it'll take 18 months. Once they can do that, the new pipeline of products that they're building, I do think will resonate with shoppers and it will sell at full price. But once again, it's an 18 to 24 month turnaround in China, in my view.
Talk to us about, new product development and new product introduction. Are there certain verticals they're targeting, whether it's running or lifestyle or other types of activities?
So running is a core category that they're focused on. They have launched a new innovation in running. Running actually with their new pipeline has done very well. In the US, we saw that running was up nicely, whereas the rest of the business was down slightly to up slightly, depending on the quarter that you look at over the last 12 months. We also think that they're focused on sport. So when you think about Nike, and if you compare it to Adidas, I think there's a big difference in the way that they're approaching their businesses, which allows both of them to succeed. Nike is focused solely and most importantly on sports and performance, whereas Adidas has owned for the last few years the lifestyle category. And I do think that Nike's focus on sports is the right one, and that is where they should be to drive this turnaround.
What about tariffs, Poonam? Tariffs is certainly something that affects Nike. I know that Vietnam and the U.S. has reached a trade deal. Most of the footwear in this country is manufactured in Vietnam. But how is Nike managing through this headwind?
So the headwind is here and it's here to stay. Nike has selectively increased prices to combat the tariff impact. It's also negotiated supplier relationships and found efficiencies internal, just like the rest of the space. Nike isn't alone in the tariff situation. We do think that, tariffs will continue to impact margin in 2026, as well as the shift from DTC to wholesale. The wholesale business is doing better, and Nike is more focused on it today because it had lost focus years ago. So that mix shift is negative. That said, as more full price selling takes hold, as we see signs of China improving over the next 12 to 18 months, those are both areas where they can help to recover lost margin. 2026 calendar year is not a margin story for Nike. It's a top line story. I think 2027 is where we can start to talk about margin expansion.
Poonam, when your discussions with Nike and other consumer products makers and apparel makers, what's the consensus today about the consumer?
The consumer is mixed. The luxury or the affluent consumer is clearly doing better than the low-income consumer. And we do think the consumer will continue to make choices in where they shop. But we think the consumer is looking for fashion. It's looking for newness. It's looking for what's hot in the market. And as long as brands and retailers can be on trend, they will drive sales of those products because that is where the consumer is shopping on trend product.
How much rope are investors willing to give Elliott Hill?
I think you do need to give him another year. We need to give him 6 to 12 months to start to see China inventory moderating and the situation beginning to unfold. For the rest of the world, I think he's proven that things are becoming stable and that they are on the uptick in 2026, especially later in 2026.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's talk a little bit about Amazon, particularly the web business here. It's obviously been a tremendous growth driver for this company over the years, and certainly been the vast majority of its operating income comes from the web services here. And the question is, how fast can this business grow as it continues to scale? Our next guest has a thought or two. Anurag Rana, technology analyst for Bloomberg Intelligence. So, Anurag, you step back, you take a look at the AWS business, Amazon Web Services. Where are we kind of in the growth trajectory of that business?
Yeah, thanks, Paul. So happy New Year, everybody. When you look at AWS, one of the narratives over the last 2 years has been that they have been a laggard in AI. And large portion of that is because ChatGPT, before the contract change with Microsoft, was only hosted on Microsoft Azure. As the capacity constraints started, Microsoft farmed out some of that business to CoreWeave and then Oracle and so forth. But in the most recent agreement, you can see that ChatGPT can be hosted on other cloud providers. So that's one area to focus on. But the big thing for AWS is it's an enterprise business. It's not so much a consumer chat operate. So this is the year where we think that thing kicks off. And what we are thinking is the growth rate for AWS improves successively every quarter going into the end of the year.
So just remind me, and probably everybody who's listening and watching, has Amazon invested in OpenAI or any of that type of thing? Are they part of those, what people refer to as circular deals?
Yeah. So Amazon is not directly invested in OpenAI. They have a new contract with them right now, but there is a rumor that is, in what we heard a month ago or so. But they have invested in Anthropic. So that's an area where, when you are partnering with the second largest LLM provider, I mean, I'm not counting Google because it's part of a big conglomerate, but a pure play, vendor, which is Anthropic. So they have invested in that. They partnered with them, and we think that actually workloads also go up. We recently did an AI survey, and part of what we found out was software companies are using Anthropic more and more, mostly for the coding reasons. And I think if that accelerates, that actually helps out Amazon as well, because some of those workloads do get up to AWS. The big part of the AWS story is it is the largest cloud provider. So the successive growth rate, or to see a big number jump over there, unlike a Google, it is the delta is huge, or the growth rates are not the same. So, but what we think this year, some of those enterprise workloads start to flow in as more their capacity comes online. They have invested heavily in data centers, and some of that actually shows up this year, and that we think is going to help them improve their growth rates.
So from a competitive landscape position, how do you think of Amazon AWS in the AI space?
Yeah. So when you look at the traditional space, they are the clear leader. But when you look at the AI infrastructure space, that lead is starting with Microsoft because they got ChatGPT to begin with. So that's one. Then you have Google doing very well with their TPU stuff. Oracle and CoreWeave also getting into that. But Amazon still has a very large portfolio over there. And what we think is going to happen this year is they have been spending a lot of money to expand that data centers. They're going to get more and more AI infrastructure orders because, at the end of the day, they have the capital. They also get the same chips from NVIDIA. They have the luxury or the know-how to build those data centers and plug these things together. So I think this is the year where they kind of break through from a lot of this narrative of being an AI laggard.
And that's kind of reflected in the stock, Anurag. I'm just looking at over the trailing 12 months, only up about 5% here. So
exactly.
Great, lagging market. So is the reason because they just haven't necessarily got the full AI, kind of wind in their sail?
No, because the kind of work they're doing is very different. The first phase of AI boom that we have seen is in the consumer app. It's in the ChatGPT and the Gemini, what we have seen. They're not enterprises. They're not large banks that are, adding more AI capabilities. But we are in that phase of enterprising adding more AI capabilities. And when that happens, they have the large infrastructure, plus they have a lot of the data that these big companies reside in the Amazon ecosystem. I think that's where they benefit the most.
I mean, it's not very often in the last, 15 years where we could say Amazon is cheap or Amazon looks like a good buy relative to its peer set. But I mean, if you have a certain time horizon, is that what the bulls are saying here?
Yeah, I think that's where it is that, so far the narrative has only been about OpenAI and ChatGPT and Microsoft. I think that narrative starts to change this year with more and more enterprise adoption. And, you and I talked about it just a few weeks ago that we did an AI survey where enterprises are really looking forward to deploy some of these AI tools internally. And that's not going to happen in isolation. They have to build that on some data framework, some kind of AI framework. And that's where AWS comes in.
Do you think, just broadly speaking, we're going to hear anything out of CES as it relates to AI? Anything big, do you think?
Not on the enterprise side. I think a lot more of the toys that people think about, whether, you have a 3-fold phone or more AI assistants, but that really doesn't move the needle for some of these cloud vendors, largely because they are predominantly, exposed to companies spending more on enterprise or AI rather than, consumers.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.